Around the world, economies are grinding to a halt as businesses are being asked to slow the spread of the coronavirus outbreak. Some very difficult questions are being asked. Back in 2003, we see SARS wiped 0.5% points off the China's annual GDP, but the rest of the Asian Pacific region at that time resumed its economic growth, and there's only a short sell-off in the stock market outside of China. COVID-19 is far more contagious than SARS and causes greater damage to our economy. It is a bit unpredictable when the economy will bottom and when it will fully start the recovery process. We hope the virus is contained and the domestic demand can recover. It is an important time to have confidence and positive sentiment on domestic consumption. The situation in other parts of the world are also quite challenging. The US has the most confirmed cases in the world and expect to peak very soon. The economy is projected to contract in Q2 and Q3 for US. Japan is hit as the Olympics this year cannot happen. Europe is facing a very difficult time as they have the most cases per population. There are also a lot of uncertainty about India and other developing economies, as we're not sure if the medical system there has the capacity to conduct enough testing and provide enough treatment. Compared to SARS outbreak in 2003, we are now linked with global supply chain much closer. If the rest of the world is in trouble, conditions will be very difficult for China to do very well in its economy. In 2019, about 20% of China's GDP is export, so that foreign demand is affected. I use the value of shipping labels from China to the US as an example here. Comparing Q1 of 2020 to that of 2019, we can clearly see export started to drop since mid-February. A particular sector that needs to be watched carefully is manufacturing, with intermediary products, the components, the parts, which are used to produce finished goods. And this alone is 70% of Chinese exports, according to the World Bank data. And this includes electronic parts, automotive components, and steel. And in 2018, companies in the US alone purchased $37 billion in intermediate goods from China. After the pandemics, some countries in the world may become more aware of the importance of supply chain security in national security concern, and then that strengthen themselves in some key exposure of the manufacturing. From the risk management perspective, it makes sense to produce essentials such as medical supplies closer to where the market is, and just in time when the domestic demand surges. China has been the most attractive region from production sourcing for a long time due to low cost, market access, quality, and supply chain performance. It was primarily the labor costs that drove companies out of China to lower cost countries like those in the Southeast Asia. Whether it is man-made trade war or it's a natural pandemic, to a certain extent, I think international capital they have seen the needs to diversify the risk. However, China's advantage in manufacturing cannot be replaced in the short term. At the same time, I think it's inevitable for China to upgrade the economy from polluting, export-led manufacturing towards a high-tech, more green, sustainable, and service-driven one. The pandemic discloses some disadvantages that relying too much on sourcing or offshoring instead of deglobalization. Maybe there is a globalization 2.0 that even the physical goods market globalization is reaching to a peak, but there's still plenty of room of globalization to push in terms of financial globalization, technology, and the knowledge globalization. For the challenges in tariff and taxes, a more global layout can enhance the flexibility of the supply chain, thereby reducing the negative impact of sudden risk. We observe that for financial globalization, China should just keep reforming from export trade to overseas investment, encouraging the company to acquire or open foreign subsidiaries, produce local, and participate in overseas market competition.